I'm James Turk. I'm a director of the Gold Money Foundation, and it's my pleasure to be here today with David Tice, who is the founder of the Prudent Bear Fund, and importantly, the sponsor of a watershed event in 1999 called the Credit Bubble Symposium, where he brought in speakers from all over the world and basically laid out far in advance what was happening in terms of the bubble that was occurring in the United States and the subsequent credit collapse. David, I wanted to talk, starting with that. What did you see in 1999 that most people were missing?
Well, I saw in 1999, James, the fact that we had asset inflation and that this reckless money creation was providing asset inflation. I was a big believer in von Mises and Rothbard, and that this asset inflation had created the internet bubble, the telecom bubble. From 96 to 99, the market went up 4 straight years. I'd started the Prudent Bear Fund in 1996, and you'd think that I would have been completely, beside myself, pulling out all my hair. But I understood that this was simply asset inflation, and it would end badly. And felt like consumer was borrowing far too much money, governments were borrowing way too much money, and it would end very, very badly. And there was great academic evidence supporting this. However, nobody really saw it.
So 1996, as I recall, was the year that Alan Greenspan, who was the chairman of the Federal Reserve at that time, was talking about irrational exuberance in the stock market, but we went a few years more. And this was being fueled by fractional reserve banking, banks continuing to lend and lend and lend?
Exactly. And I called on that famous speech from Greenspan. The Dow is about 6,300. And really, he laid it out for us. And I think he tried to do the right thing for a little while, but then he did not possess the courage that he should have. And frankly, we had wrong-headed economic theory. The Keynesian monetarist theory were all saying this was okay. And I used to call it the Al Davis School of Economics, which is just print money, baby. And as long as the CPI remained below 3%, there was no real concern about reckless money creation.
But isn't that still basically the same policy, and therefore they're still on the wrong road? I mean, Bernanke has basically only one remedy for everything that ails the economy, which is just print, print, print. And obviously that's not the right answer, correct?
These are one-trick ponies, James, and that certainly is a policy today, and that's why I'm trying to do what I can to support the Keynes versus Hayek videos that are out there. These guys at Economist Stories and Mercatus are doing a great job trying to educate, and we need to get policy back where people understand von Mises, Rothbard, Hayek, et cetera, and move away from Keynes.
Yeah. Keynes is famous for the quote that in the long run we're all dead, but a number of people are starting to recognizing in the long run Keynesianism is dead because it's a false policy, because it's built on the assumption that you can borrow to infinity, and obviously you can't, because it has implications that ultimately the currency is going to be destroyed. So potentially the dollar is going to be destroyed, in your view, as a form of currency if we don't get off this road?
Oh, in fact, the famous quote from von Mises is there's no end to a credit-induced expansion, that you have two choices, either a voluntary abandonment of that credit expansion, which means our policymakers become statesmen and do the right thing and end the credit excess. And of course, we've seen nothing of the sort. Or the second is a complete and utter destruction of the currency involved, which is where we're on the path.
So despite the political posturing in Washington surrounding the debt limit increase and a lot of the talk about cutting the budget, you don't really see enough happening in Washington by policymakers to suggest that they are doing the right thing.
Yeah, these guys are still whistling past the graveyard. They do not really understand, and unfortunately, with the terms that we have, 2 years for Congress, 6 years for Senate, 4 years for President, everybody's trying to, kick the can down the road, and they don't want to do what's required in order that's required for discipline. And because they're still listening to policy from the Keynesian monetarist theory that says it's going to be okay, and therefore they kick the can down the road, and they feel like, well, they're not going to be, they're going to push it beyond, the next election, and therefore it's going to be okay, and it's not going to be okay.
If they don't have the political will now to solve the problem, do you think they'll have the political will in 2 years or 4 years or 6 years to solve the problem?
Unfortunately, it's going to be like a drunken sailor, and they're going to keep drinking until the booze is taken from them. And that's going to happen in the credit markets where there's going to be a failed treasury auction or something of the sort, where the dollar declines below 70 or 60, et cetera, where gold goes to $5,000. That's what's going to cause reality to come back.
Yeah, you mentioned a drunken sailor. I had a funny thing happen to me. I was using that example, comparing politicians to drunken sailors, and an old Navy guy came up to me after my presentation and said, don't compare politicians to drunken sailors. It gives drunken sailors a bad name.
Exactly, that's exactly true.
And what's happening in Washington today is, I think, really just a shame that people just aren't standing up and making the tough decisions that need to be made, but recognizing that we're on the wrong road. Going back to 1999 and your credit symposium again, the other part of the equation was that you recognized gold as being undervalued and recommended moving into gold at that time. What are some of the things that you saw back then?
Yes, what I saw back then was that gold was a way that you could protect yourself from this fiat money. And in fact, in Prudent Bear Fund, we made an extraordinary amount of money investing in junior and senior gold mining companies that made a lot of money for Prudent Bear and allowed us to earn a better rate of return over the years, and helped hedge us where we lost some money in shorts over the next 10 years.
Because the stock market continued to climb higher?
Well, the market was up from 96 to 99. We really didn't make any money in gold in those years. We made money 00 to 02, but from 03 to 07, when Greenspan essentially engendered a housing bubble and a mortgage finance bubble, we made a lot of money in gold stocks, because although equity prices levitated, gold levitated even more.
Yeah, that was responding to the low interest rates and the inflationary policies that were resulting as a consequence of those low interest rates.
Exactly.
So it was a natural hedge by owning gold to the what was happening in the paper side of the market and the bubble that was being created in housing.
Exactly.
Yeah. What about the gold stocks? Let's talk about them a little bit. What are your views currently? Are you bullish on the gold stocks? Because they've been getting beaten up a little bit or underperforming relative to bullion itself. Particularly over the last couple of months, as gold has soared to new record highs against most of the currencies in the world. The mining stocks, they've moved up a bit, but they seem to be in a sideways trading range.
Yes, gold stocks are very weak right now, and I think represent an extraordinary opportunity. Of course, back in 08, gold stocks got destroyed, and because they are also equities, and the junior miners really got crushed because they're dependent upon new capital addition. Mm-hmm. And the seniors are selling at extraordinarily cheap prices, and in fact, I think individuals should really own gold stocks, gold and silver, platinum stocks, as well as being invested in bullion now.
Do you have any recommendations as to how a portfolio should be adjusted between making an investment in the stocks themselves as opposed to holding bullion just for liquidity purposes?
Well, I think people should own gold and silver bullion. I am a shareholder of goldmoney.com. I'm also a big customer of goldmoney.com. I think that's a great place to hold your bullion. I also own a number of junior gold mining companies. I've typically not owned the seniors, but I'm now starting to, invest in seniors. Mm-hmm. I'd say probably, a third. I'm more invested in silver today than gold. I'm a believer in what Eric Sprott talks about as far as silver having even more extraordinary potential than gold does. Yeah. And I'd say maybe it's kind of an individual preference as far as how much bullion versus how much metals, equities. But a nice blend would be appropriate.
And when you're talking about bullion, you're talking about physical as opposed to paper representations of gold.
I'm very much a believer in physical.
What are some of the things you look at in terms of the mining shares? Where do you start with management, or do you look at the balance sheet first? Or
the balance sheet's not as important. Management's critical. Obviously, the property is critical. However, you also need to. I've been lucky enough to have invested with a gentleman at Axman, Cal Everett, who's helped me make a lot of money over time. Mm-hmm. And we've invested in junior gold mining companies. They've done very, very well. But Rick Rule also, who's opening up the Sprott domestic operation, is
right. His operation was acquired by Sprott Asset Management.
Exactly.
Yeah.
So, he does a phenomenal job in identifying, managements and properties. He's done a great job over the years.
When it comes to the mining shares, I've often said to people that if you're going to get involved in the mining shares, own at least 30 in order to get the statistical diversification of a basket of shares, because some are going to do very well, some will do very poorly, and some will be in the mean, in the middle. And rather than just picking 1 or 2 shares and hoping that you get it right, by statistically diversifying over 30 shares, it makes sense. And if you can't do that, then go ahead and put your money with a fund and a fund manager who has an established track record. Do you basically agree with that approach?
Oh, I so agree with that, James. And in fact, the reason we made so much money in Prudent Bear and mining companies was this conditional probability approach, where there's a lot of people that will not invest if they feel like they have less than a 50% chance of making money. However, in the mining world, it's very likely you might have a 25% or a 20% chance of making money. Mm-hmm. However, you might have a 20% chance of making 5 to 1 or 10 to 1. Mm-hmm. And if you have 20 shots that really have 20% probability of making you 20 to 1, 10 to 1, you should take that bet, because on an expected value basis, you'll make a lot of money. Yeah. But it means you've got to invest in a lot of those companies, and it means you cannot delude yourself into telling yourself there's 20% probability when it's only a 2% probability.
Right, and if you do it yourself, there's a lot of work associated with analyzing the companies, valuing the property, and everything that goes with it. Whereas in a fund, you leave it up to the fund manager who has the record and the time, to actually do that.
Yeah, another guy that really does a good job is Kevin McLean. I think his name is, from Century.
Century, yeah, okay. What else are you looking at in the world today in terms of portfolios management? Are there any other asset classes that you see particularly undervalued or overvalued that might be available on the short side?
Well, I think the market overall is way too high. I think it's going to decline. I've been a short seller for a number of years. However, I've found it frustrating to be short stocks right now. I'm still obviously a big owner of Federated Prudent Bear, that I founded 15 years ago, now capably run by Doug Noland and his team. I'm a believer in that the U.S. dollar is going to decline. I'm a believer in, I've been buying the VIX ETF, mm-hmm. But just because I think that the VIX is going to levitate again, and if you can buy it in the 20, 30 range, it's going to go to, over 100, and there's a lot of money to be made right there. So that's a pretty easy asymmetric bet to make.
Are you basically suggesting that there's going to be another Lehman type event occurring here by, buying the VIX?
Yes, I think there's going to be, some type of an extraordinary credit event to come, and it's going to probably involve the currency. There's going to be another meltdown down the road. It's just a matter of when. Yeah. What's interesting is, a lot of people at this conference, see this, and a lot of the people here saw it all coming in '08. And if you look at the conventional economists and strategists that are out there, the ones that are all telling you everything's going to be okay, all those guys essentially missed it in '08. They had no idea what was coming in '08 and '07. But the people that got it right in '08, '07 just saw that we kicked the can down the road. We just relied on the same Keynesian policies in order to print money, follow the same Al Davis School of Economics, and they realized how much worse it's going to get when eventually the ship hits the sand.
Yeah, understood. Is it likely to be a sovereign debt crisis that triggers this next problem, or is it something within the banking system, or a combination of both? What are you thinking?
Probably a combination of both, because a lot of the European banks have such high sovereign debt exposure, and I worry about the European banks. I worry about the U.S. banks. You look at what's happened in some of the U.S. banks, their stock price performance lately. Bank of America, around $9 a share now. The U.S. housing market has not really recovered and looks like it's going through a second leg of decline. There's been pretend and extend policies that have been followed by, all the banks really around the world where they have not, written down, these assets as they should have been.
Yeah, this is something that I've been following, since the March of 2009 low, after the Fed came in and started doing quantitative easing and the stock market started rising. It's interesting to look and compare the overall stock market indices to the financial sector within the stock market, because it hasn't really been keeping up with the overall stock market. And that usually that kind of a bearish divergence suggests that there's still more problems in the financial industry. So,
Right.
the way I see it as well is that we are going to have another Lehman type of event, whether it's going to be a bank or a government, or perhaps even something that people really aren't talking about, but a derivative issue. Because ultimately that was what there's the big issue in Lehman: who is going to take care of all those derivatives it had on its book, and who is going to cover all of those losses. So
exactly, and who knows what else could happen? Another black swan event. There could be another geopolitical event. Issues in the Middle East today. I mean, there could be another war. Unfortunately, governments typically resort to external enemies and create external enemies, and you look at the hostility around the world with inflation picking up and protests by thousands of people, hundreds of thousands of people around the globe because of this fiat money has created rising prices for energy and food, et cetera, and there's a lot of people that just don't have that much income.
Yeah.
And you look at that there could be another outbreak of terrorism again. There's all kind of black swan events that could occur.
We're in a financial bust, and I think you agree with me when I say that. What would be your sense as to how long it's going to be before this financial bust, ends and economic activity that's more normal starts to resume? Is this something that is coming soon, or is it going to be a few years yet, or perhaps even longer?
I wish I could be an optimist, James, but the problem is our policymakers don't really understand the discipline that's required. And I understand the position that they're in because, as Henry Kaufman said at our symposium back in 1999, and he was asked, what we should do about it today. And he said, he looked at the interviewer in his eye and he said, the Fed missed its timing. So in other words, the Fed had screwed up so badly, even from 1996 to 99, by not doing the right thing earlier and not, imposing the discipline that was required back earlier. And so what he must be thinking today, after another 12 years of kicking the can down the road and essentially enacting all the wrong policies and creating more and more and more, reckless credit extension, it makes the aftermath all the worse. And therefore, I feel for them because the hangover that we're going to have to go through is going to be so pronounced and so ugly, it just boggles my mind.
Yeah. The best way to prepare for that as an individual would be to own gold and silver?
Well, I think to reduce your equity exposure, own gold and silver, protect yourself as best you can, enjoy life as much as you can in the interim. I mean, you certainly can't go live in a cave, but tell your friends about it.
Yeah. Reduce exposure to the U.S. dollar?
Yes. People don't realize that they think they spend their money and they earn their money in dollars and they think they're okay. However, we import so many goods today, and the prices are likely to go up a lot with the U.S. dollar falling. I mean, there's likely to be a massive currency event that's going to change the world that we live in.
The Scottish historian Neil Ferguson said that the U.S. He said that U.S. government bonds, although they're perceived to be a safe haven, they're a safe haven like Pearl Harbor in 1941.
Yeah.
I guess that's something you agree with.
I would agree with that.
So you would avoid U.S. government bonds and T-bills as well?
I definitely would.
Is there any currency that you see as a refuge other than gold and silver? I mean, is there any national currency that you think is better than others, or are they all basically in a rough, tough position?
Well, we started the Prudent Global Income Fund that's been renamed the Federated Prudent Dollar Bear Fund. And although I don't really have a relationship with the fund anymore, that was a fund I founded in 2000, because I saw the decline in the US dollar ahead. Mm-hmm. We actually own gold stocks in this fund as well. Mm-hmm. And we're invested in the Canadian dollar, the Norwegian krona, we're invested in the Swiss franc, we're invested in a basket of currencies. And I think it's unfortunately going to be such a tough time, because just like in the 1930s where we experienced competitive currency devaluation, I mean, you see that today. The Swiss, are announcing that they don't want people rushing into the Swiss franc. The Swiss franc has levitated. You see, Brazil and a number of other countries that are trying to, reduce, flows to their currency because they're seeing too much appreciation.
Imposing capital controls to prevent the money from coming into the country.
Right.
Or, it's interesting, back in the late 70s, the Swiss actually put on a negative interest rate. So if you had money deposited in a bank, they actually took the interest out of your account at the end of the year, in effect. But I read in the paper this morning that I think it was Mellon Bank, Bank of New York Mellon, that was starting to impose large fees if you're looking for safety, because they were viewed as a custodian bank and didn't have a lot of credit exposure. Mm-hmm. So you've really got some really weird things happening, which I guess is a sign that things are spinning out of control.
Yeah, and a place where people should invest is just invest in education. Things are moving so quickly, and your website has been a great source of smart people talking about these things, and tell your friends.
Yeah, thank you. Yeah, what we've been trying to do is to get an educational message out there. People don't necessarily have to agree with the message, but it's a point of view that I think people would find valuable, and at least something to test their existing knowledge against, and to see whether or not, from a logical point of view, the precious metals in particular make sense as a way of protecting yourself in the tough times that I think we still have coming.
Yeah, there's going to be, John Embry was just speaking at the conference, there's just going to be an extraordinary transfer of wealth, between people that get it and people that don't get it. And there's been so much cognitive dissonance of the people that don't believe. And, there's people that think with, gold at this level that it has to decline, and they think it's a barbarous relic, and they simply don't get it. They just have to go back and educate themselves.
One of the things that I've been stressing from when gold went over 1,000 an ounce, and people are saying it's overpriced, in a bubble, et cetera. I go back to the 1983 when the Dow went over 1,000 after being below 1,000 throughout history and having touched that level, back in the late 1960s. I remember very well when the Dow Jones Industrials got up to 1,100, 1,200, people saying it's overpriced and it's going to fall. But what they lost sight of is there's a difference between price of an asset and the value of an asset. Right. And the Dow was very undervalued in 1983, and it just kept going up as a consequence, regardless of the price. And it's been my view too, that the gold too here is still very undervalued, despite the fact that its price is going up, and that we still have a long way to go on the upside.
We have so long to go, and I want to point out a quote that I understood this concept before, but I did not have the facts committed to memory. But you pointed this out at the Cheviot conference, I guess back in January, about how over the last 5,000 years, gold or silver or precious metals have generally backed the currency that's used for world trade. Yeah. It's only been in the last 40 years where gold has not backed that currency, and therefore, because central bankers felt like after Nixon took us off the gold window, that it wasn't required and that central banks could handle it themselves. And so what we've experienced has been due to that. So do you really think you can defy the other 4,960 years.
Yeah.
So that's what we're getting back to, and so that's where we are in terms of gold.
Yeah, it's proven that central banks, can't do it, and which is one of my favorite themes, that the barbarous relic is central banking.
Yeah, exactly.
David, it's been a real pleasure. Thank you for taking the time out, and I wish you the best of luck in the future.
Thank you, James.
Thank you.